one way. And they don't really realize that if we didn't have speculators, the markets would be much wilder than they are.
Yeah. So why don't you continue on this thinking? So you're in Montana, you're a young man, you're wrapping your idea around trading, you're starting in stocks. How did you make the migration to thinking about commodity futures? I mean, I naturally, I think, and I've talked to Salem Abraham as a trader out of Texas about this, growing up around cattle and whatnot. I think it's a little bit different than kids that might grow up in the city. You actually see and understand some of the mechanisms for the buying and selling of animals at a young age.
When I understood math, a broker told me that I could get, without having to pay interest on a margin account, I could control $30,000 of pork bellies for $500, or I could buy $500 of stock where I get my biggest bang for my buck. And once I had that realization, I thought, well, futures is a lot more attractive in terms of what your potential is on the upside and, of course, on the downside as well. But that was the really switch point, was just the economics of it, that I got a much better deal, and that there's real demand and supply for corn and wheat and gold, and there is no real supply or demand for IBM or Apple or Google. I mean, you really don't need a share of Google. You can live the rest of your life without it. But you can't live the rest of your life without wheat and sugar and coffee and corn and gold and silver and all these things. So we have real data about those markets, real fundamental data that we don't have in the stock market. There's no true demand for them.
How did you start to put the pieces together, though? Because for the average trader, for the new trader, even for the established trader that's out there, it's a lot of different factors going on. So you have the emotions of it all. People just getting excited. They flip on CNBC and there's 6 suits jumping up and down, and you start jumping up and down, and you call your broker. But then there's the issue that you brought up with the leverage inherent in commodity futures. If you don't have risk management, if you don't have a money management strategy, you can end up in a bad place fairly quickly. So how did you start to put the pieces together about the emotional part of it, the money management part of it? I'll maybe let you continue there.
Well, I guess I was lucky. There was no CNBC when I started. So you didn't have all those things pulling at you. I really just got into the first book I read was Joe Granville's book, and later on Joe, who unfortunately passed away a month ago, became a friend of mine, both he and Karen. His book was very inspirational about, there was logic to this business called stock trading, but it was all technical. And I traded as a technical only guy for probably almost the first 10 years. And then I met a guy, Bill Meehan, who had been a member of their board of trade, who was really into the fundamental aspect and taught me the fundamental aspects of markets. And we came together, two guys, Keith and Kevin Campbell, who run one of the largest funds now in the world, out of Baltimore, had been a friend of Bill. And it's really interesting. Bill was the inspiration for a lot of guys. And what I got from Bill was that markets get set up for big trend moves. Technical stuff, we'll call all the trends, but you get whipsawed to death. So what you want to do is put a trend mechanism on top of a fundamental conditional setup market. Then trend isn't just hoping that one of these things goes up. As a speculator, you're observing that this time, this trend change should be better than just a 20-day average crossing a 10-day average or whatever. So that was the total perspective Bill gave me, the conditioned setup markets for trend moves. And his problem, why he came to me, why we worked together, he had no clue about technical stuff, timing. Technicals are all about timing, but you don't know if it's going to be a massive move. You don't know the magnitude of the move. Just because you get above a 50-day high, it doesn't mean you won't go right back down. But if the fundamental conditions are there, then the trend change is much more sustainable.
I have to admit fully, and I think you probably know this about me, I am not a fundamental guy, and I can't add any value there. I can appreciate that there are definitely people on this planet, and I think you've had some experience there for sure, who have been able to pull it together. I know Ray Dalio, and I sometimes want to know what his secret sauce is, but Ray Dalio swears, I don't know if he swears, but he says that he trades only using fundamentals, but trades them systematically, which was intriguing to me.
Well, when we were roommates together many years ago in New York City, I think he scoffed a little bit at my technical stuff, and I scoffed a little bit at his fundamental. It wasn't until years later, that I haven't even seen Ray since somewhere in the 70s, that it was really interesting. We both pop up again with a little different trading style, but clearly I think fundamentals are the basis for the magnitude of moves. And I know students of mine who now manage money have taken my work. This is exactly what they've done, what we've always talked about. They'll take a turtle channel breakout, but only if there's a conditional entry there. And of course, then you don't have to wait for, say, a 20-day high or a 50-day high, because if the conditions are there and they're ripe for a significant move to the upside, then you can buy at a shorter time period, high or moving average or whatever your technique is, because the stage is set for a big up or a big down move based on the fundamental conditions of the marketplace. I don't disagree with trend following. I think it just has to be used selective. I don't disagree with using a hammer, except you got to find the right place to use a hammer.
Yeah, there are different approaches. I think sometimes what I do, and people get into debates with me, I've enjoyed being in the trend following world because there was so much data to observe. As a young man coming into it, I could see all this data and observe it. On the flip side, if I picked up Seth Klarman's Margin of Safety, as a young man with a political science background in my early 20s, that was a much more difficult proposition for me to wrap my arms around.
Well, margin of safety, I think that's one of the incredible learning experiences that I went through, and that maybe every trader eventually has to face, and that is the risk control aspect of this. It doesn't matter if you've got the greatest system in the world. If you don't learn how to control and bet size and manage your account, you really have to manage the markets, your trades, you have to manage your equity, and you have to manage your emotions. You've got to really touch on those 3 legs if you're going to be a successful trader.
Well, I brought those up a second ago. So why don't I let you expand on the phrase money management? Because even though people have heard it, it's not something that resonates with a large segment of the population. Many people, you can take a doctor, an attorney, a young man out of college. It's a subject that's still, you've been at this for a long time. It's a subject that's still in the weeds. It's still hidden away. The idea of money management, bet sizing, position sizing, however one wants to call it.
Well, I'll make it real exciting here. I took the $10,000 to $1.1 million in a real-time trading championship because of money management. My daughter, when she was 16, took $10,000 to $110,000 real dollars in a trading championship. And a lot of my students have done this similar thing or comparable. Nobody's got our records yet, but they're trying and they do really well. And it is, sure, they're decent traders, maybe even good traders, great traders, but it's the money management that gets the exponential growth of the account. But that sort of has two sides to it. And really, to simplify it, is that trend is the basis of all profits. No trend, you're not going to make a nickel. But trend is a function of time. So the time you're in the trade, it gives you more opportunity for trend, which is why day traders have the deck stacked against them. Time runs out at the end of every day. They cannot catch a big move. So they have to bet large to make a lot of money. My game is to bet small. And if I lose, then I can only lose small. Whereas if I catch a trend move, I can catch a substantial profit because I have time in my favor. So your time frame is part of your risk management. And the overall underwriting rule is really bet small to win big. You have to bet a correct amount based on your system. But even at that, as I mentioned earlier, if your emotions don't allow you to handle a $50,000 loss and you're trading $1 million account, whatever, if your emotions don't let you handle that, you can't make that size of a bet. It isn't just the math of it. You got to actually have an emotional quotient on what risk you can emotionally handle, and then strive to find where that optimal F is that Ralph Vince has written about.
Yeah, Ralph was on the show. Ralph's a really interesting guy. I'd love to meet him in person. He was awesome.
He's the smartest guy I've ever met. I've met a lot of brilliant people. I don't know if you're aware. You probably read Ralph's books. Ralph never took a class in math.
Yeah, it's amazing.
That's all self-learned. He's amazing and just a great guy. Just had a lot of good times together.
Let me keep going on the money management though, because I think let's phrase it this way. If I've done this before at an event, you tell people, you say, listen, okay, you got $100,000. How much are you going to bet on each trade? And I've asked a room of 100 people this before, and it's amazing the numbers. I mean, you've got people that raise their hand and say, I'm going to bet $10,000 in each trade. They only got $100,000. They're going to bet $10,000 in each trade.
Well, if your emotion can handle it, and I would precede it with that, the maximum bet that I would make would be a 4% risk or $4,000 potential risk in the trade. I think that is the optimal number, all things considered, for most all traders. Probably a 2% is more manageable. And people think, well, I can never make much money with a 2% risk. A couple of years ago, when in Australia, I started a $100,000 account. A year later, it's a little over $1 million. And it was on 2% risk bets. Probably most were 1% risk bets. So you don't have to bet big to win big if you're catching large moves in the marketplace. I think optimally, and I can show mathematically why 4% is about as heavy of a bet as you want to make. Or as a risk, not a bet, but a risk. That's how much, if I'm wrong, I'm going to lose 4% of my account.
And you would consider 4% on the heavy side.
Pardon?
You would consider 4% to the heaviest end that you would go.
Yeah, to the heavy side. And here's why. It's not uncommon for me to have 3 or 4 losing trades in a row. So if I have 4 losing trades in a row at 4%, I'm down about 16-20% of my money with slippage and whatever. And so that's a frequently happens in everybody's systems, everybody's trading approaches. So I have to be willing to have an equity drawdown I can live through, not sit through, but actually live emotionally through that. And a 4% risk that's pretty gutsy.
Why don't you talk about the emotions? Because you just said it, living emotionally through it. You know, somebody's listening and maybe they think they know what you're saying, but do they really know what you're saying? Is it the waking up in the morning? Is it you're thinking about it too much? Or, and I'm not saying you, I'm just saying the wrong way to do it. You're thinking about it during the day. Talk about that, the emotions of it all.
Well, I have a lot of experience in doing the wrong things in the markets, so I'm real qualified to speak on this one. The other things I don't know, but done a lot of wrong things in the markets. And I think the underlying thing is the human brain is wired to be right at all costs. So we get into arguments because we want to prove we're right. People kill people on freeways because somebody cut in front of them. So we'll be dead right, literally. We just have to be right. And in the markets, you can't be all right all the time. And you have to learn to accept that. And if you can't accept that, you get really frustrated and very angry about the markets and that you're losing, you're not making money. The guy next door, your brother-in-law, is making more money. And it isn't just the size of the loss. It's the fact that you're losing, and maybe 2, 3, 4 times in a row you lose. And that makes you think you're a loser. You get into all sorts of emotional traps. I don't know if you're aware, my son's a psychiatrist trained at Johns Hopkins and did an interview with 20 major traders, big-time traders, names you know. And the takeaway from his in-depth personality profiles of all these people is, he's the first person to just interview successful traders. None of these successful traders have really big egos. They're not overly confident people. And that was one of the most important takeaways to me, is that we have this impression that traders are gunslingers and they're totally confident, and those are the losing traders. The winning traders don't have a great deal of inner confidence, and that's why they control risk so much better than guys who think that the God's gift to the markets.
I feel very fortunate to have sat down, talked with, become friends with, shared experiences with some men that have so much market success that their kids, maybe 500 years from now, will still be living off the residual. And you're right. Most every one of those people that I've had a chance to be around, names that people would know, they put their pants on exactly the same way. And they just act down to earth. They've had a system, they've had an approach. Maybe there's been a little luck on their side, but they've grinded it out, and they've been at the right place at the right time, and things have taken off. But I find they're just down to earth, very down to earth.
Yeah, you look at a guy like Steve Cohen, who's just, you wouldn't have any idea this is a billionaire, 4 or 5 billionaire type guy, done 30% a year for 30 years in the marketplace, and he doesn't have that persona that the movies have made out, or somebody like Paul Tudor Jones, Ray Dalio, and these guys are pretty much salt of the earth people, and understanding that, I think, traders is. Another interesting thing that Jason's book pointed out, as research showed, is that all of these really successful traders found a strategy that fit them. So some are fundamental, some are technical, some don't want a system. Some, if you gave a system to, they could never follow it. But they're really good traders on their own, using their own discretionary ideas in the marketplace. And they had to come to that notion. Some went from going to systems discretionary. Some went from discretionary realizing that they had to be a system trader. Your personality dictates largely the approach that you should be using in the marketplace. And too often people say, oh, Larry Williams, I'll just follow his stuff, or I'll just get the turtle trading system, or whatever, not realizing, does that fit you? You really have to answer that question.
And that's a good question too, what is the definition of fit? And I think that not as much research as your son perhaps, but some of my casual observations is that most of these men they said, well, what is this a good opportunity? What's the science behind it? Let's stick with it. Let's execute it. Let's run it like a business. Let's have a profit center. Let's run it like a business. And I think that seems to be a common thread that I've seen in so many of the traders that I've had a chance to sit down with, learn, and interview from.
Well, I think the ones that you've interviewed, which are legendary traders, they are different than guys like me. They are so much smarter because they're not only great traders, but they put together business enterprises. I'm basically a writer. I'm into green journalism that turned trader. And these guys are business guys that have put together organizations of thousands of employees underneath them, managing billions of dollars. So not only are they great traders, they are brilliant, absolutely brilliant business people. And there's a real difference between just the trader and somebody who can make a business out of the art of trading. I mean, I have so much respect for these people. They are just so far ahead of most of us in terms of the intellectual qualities of their life. Oh my gosh, amazing.
Taking on the responsibility of losing money for other people is not easy.
Not fun.
No, that's not fun at all. Hey, listen, let me shift gears on you a little bit more too. So the idea of markets changing or the conditions in markets changing, I think many times people, maybe new traders, they approach the markets and they get caught up on this word change. So let me ask you, big picture wise, how much has really changed about the condition of markets since you got started to today?
A lot has changed, but it's technical change. It's change in how long it takes news to get disseminated. I'd get the Wall Street Journal 3 days late. The content and the delivery time period of news took much longer. Now it's instantaneous. So that's one thing to deal with. But the big change really is, we've gone to electronic markets. I made fortunes off the opening gap from the day closed to the next day's opened. And because we had a time period of, 10 hours, 12 hours where nothing was happening, well, we don't have that gap anymore. So I had to seriously alter a lot of my trading styles because I didn't have that opportunity to take advantage of anymore. So that's a huge, huge change in terms of my trading. But I still think supply and demand drives the markets, and the technical emotions are really technical, I think, measures emotions. The wiggles and waves as we go from point A to point B are technical. The overall trend from A to B is fundamental. And those emotions are still the same. As you know, we can go in any country in the world and look at their markets, and they just look like the markets here, except maybe China because you can't sell short. But the same patterns are there that we see in our market. So these aren't chart patterns. These are patterns of emotion. And we're all humans. We all have fear, greed. Doesn't matter what your culture is. So that stays the same. How we trade markets, we're all electronic. There's a lot more traders now, so they're a little more emotional. That's a change, but not the core fundamentals. Those haven't changed.
Let me shift gears on you again. Since you've seen everything, so I'm going to keep asking questions. So in the last couple of years, and I had a hedge fund buddy of mine call me recently, and he was having a conversation with a fund manager friend of his, and they were talking about volumes in Chicago, and they were talking about MF Global, and they were talking about a VIX, at least into the last month or so, has been non-existent. And they were also talking about London, and they were talking about funds, big U.S. funds moving offshore, and Dodd-Frank and QE. So is there something structurally going on that maybe has kind of come out of the two-headed monster of MF Global and current QE policy that is possibly changing the structure or the trust in the markets, the commodity markets that you've known since you're a young man?
Yeah, the trust is, I think, the big thing. The EDF Man fiasco, and then Russ Wassendorf. That's another great fiasco where the regulatory people won't take responsibility for not regulating what they should have. A lot of people going, the commodities are as risky as I was told they were. And so I think we've dried up some of that. There's been some shrinkage, but there's been this whole expansion of the Forex or FX market. And that actually concerns me a great deal because so many Forex people are saying you can open an account with a credit card, you only need $200 to trade, and we'll give you 100 to 1 margin. I have more respect for people selling crack cocaine on a street corner than somebody's going to give you 100 to 1 margin. And it's ridiculous. 100 to 1 margin, you're going to lose all your money at some point. It's just a question of time, this day or tomorrow.
And so we have IRS agents chasing you down, but the 100 to 1 FX margin guys, as long as I can remember, have been promoting that as a legitimate investing type opportunity, and the regulators just stare in other directions, I guess.
Yeah, well, and I think they changed it now. You only offer 50 to 1 or something, but it's all ridiculous. Like, oh my gosh, and your commission is higher there than it is in the Globex or the ICE. So, but it's all a promotional thing. And I guess that's another thing that never changes. You always have these guys out there. You always have humans are greedy and want to make a lot of money, and you have guys who will pander to that. Whether it's internet marketing or whether it's Forex or commodity trading or stock investing, there's always somebody there to indicate maybe you can make money quickly. You can raise Reddit worms in your backyard and sell them to Fisher, but there's always somebody with a deal for you.
Indicators. Something that is near and dear to you, and many indicators with your name affixed to them. I think a lot of people starting out in the markets, when they first learn of technical analysis or trend type trading, they see these indicators, they get excited, and once they get what it is, and then the next thing you know, you've got a chart you've got a chart that looks like hieroglyphics on there. There's so many things going on that it's just destined to not work, but they don't necessarily see that. Why don't you talk about the idea of KISS, keeping it simple, stupid, so to speak?
Well, I think it's really important that because all these indicators are really redundant. For the most part, if you look at the Bollinger Bands of percentage or Williams percent R or RSI or stochastic, they all look almost exactly the same. I've done presentations on this. There's not an ounce of bit of difference worth between them. Yet guys will have all these indicators or gals on their screens, and they're just redundant. And they're actually redundant at price because they're based on price. When I took logic in college, my professor Albert Castell said you cannot predict A with A. You have to use B, C, or D to predict A, but we're using price to predict price. And there are some aspects of price maybe we can look at that are helpful, but there's so many indicators that you don't know what to say. So I think you need to break down your indicators into a couple categories: the fundamental ones, the emotional ones, and the trend ones. And then whittle those down to as few of those as possible. Then you have a sensible approach. I only, on my charts, I have 3-4 indicators on my charts. That's it.
Yeah, I think for some new traders starting out, that might seem foreign, but I think it's good for them to hear simplicity.
Well, there's no perfect indicator. I mean, I've got some really great indicators, and they don't work a lot of the times. Yeah. They work often enough, but you just because somebody, as you know, people will show indicators in books, and in an uptrending market, yeah, all this stuff works, but markets don't always trend, and they never show in the books the bad aspects of this stuff. So everything looks perfect, and then you start trading it, and you run into reality that actually a divergence in an oscillator may be very bullish, but the book says it's very bearish. So you got to be so careful. As Ronald Reagan said, trust but verify.
Yes, and I actually he said that in regards to Gorbachev, did he not?
Yes, yeah, in Russia, yeah.
I had a chance to meet Gorbachev once. That was interesting.
Oh, how cool.
Yeah. Well, let me. I want to kind of wind down with you and maybe talk a little bit because I want to get some of your perspective, big picture. Look, we're going to go ahead and give your website address and where everybody can reach out to you. But I think ultimately, some of the most important aspects of being a trader, an entrepreneur, somebody that just wants to get ahead, there's just certain personal ways that make a lot of sense to be. And I know clearly by your bio, you've been a fighter. You've definitely fought fights. I'm curious, when you look back in hindsight, do you regret any of your fights, or do you feel like those fights shaped you and gave you wisdom today by going through those experiences?
Oh, I'm certain there's one or two I would regret. I can't recall them. But I think that the temperament of the Montana idea, if you're right, you stand up for it, and if you get beat up, so what? You stood up for what you believed in. And I think that actually helps in trading because you're willing to take a position. A namby-pamby guy who will run from a fight won't take a position in the market. Paul Tudor Jones was a boxer. So many of these traders have been in an aggressive form of something along the way. Charlie DiFrancesco, the largest bond trader in the history of the world, a great football player. I was a mediocre football player in college. He was great. And I think that aggressiveness maybe, or that willing to take a position, not aggressiveness, willing to say, yeah, I'm in, I think is actually helpful to trading. That's how I see it, at least.
You mentioned earlier, and I didn't get a chance, I didn't follow up on it, but you mentioned the idea of Montana and the bucking bronco. And I was thinking to the big city kid, or frankly, even worse, the suburban kid, the suburban fast food kid. But here you grew up in Montana, the idea of a bucking bronco, by its very nature, is you are going to get tossed off, and you're actually you're judged by getting back on. And I think in a society these days where every headline is, or it seems like a lot of headlines are banning dodgeball. I saw a headline the other day, a little kid apparently, and I'm not condoning any kind of violence, but I did this as a kid. All little boys do this. He held up his hand, he made like a gun symbol. He was like 7 years old, and they suspended him for school for a year. And I think there's I think there's a neutering of society going on, Larry, that's frankly frightening. Like what is happening to us that we think everything is supposed to go in a straight line, and everybody is wearing like some kind of padded suit, and there could be no injury. And doesn't injury teach us something?
Yeah, I couldn't agree more with that. That we tried to have this pasteurized, homogenized society where everybody knows what's best for us. And even if they're right, we never really learned it on our own. You can read something in a book, but until you experience it, you don't really know it. So yeah, to get tossed off a horse or get tossed off a bike or a car or do stupid things as I did, as I'm certain you did, as we all do, that was a phenomenal learning experience. And we don't get that much anymore because we're protected. That's a societal change that we're trying to transition through on part of some political people, and the other people are resisting it. That the best learning is from your experience. And certainly Michael Bloomberg saying you can't have a large Slurpee. I mean, come on, Michael. That people will have to rebel at that and have more of them, or they'll order 2 or 3 large Cokes instead of, or they would have just had one. So yeah, it's sad to see. And I think that may be why more people are coming into trading. I've seen really 2 interesting things. People do want some place where there is some exposure to risk and opportunity. And it used to be when I lectured on commodities around America in, say, the 60s and the 70s, it was all middle-aged white male. And about 1980, that started to change, and the people coming in were younger, some female, still not very many, and a lot of first-generation Americans from Germany, from Italy, from India, from Mexico. Suddenly there was a shift. The risk takers in America were no longer Americans. They were first-generation new Americans. They were the ones that wanted to risk. And that really just was a real wake-up call, like, wow, the people that want to risk are the new generation, not the old generation. You still see a lot of that.
Yeah. You were mentioning about silly things in the youth, and I was just recalling that one of my favorite experiences growing up, I was probably 19, was waking up the next morning and having two black eyes. Not one, but having two. And that actually, I don't know how many guys can actually say they woke up and had two, which means I didn't win, but I learned a lot. And I did hurt one guy in the bottom of the pile. But, I was just on a really kind of a more simple level. I should tell you about crossing the street in Saigon. So it's a city of 10 million people. There's 5 million motorbikes. When you cross the street in Saigon, you look left, you look right, you look left, you look straight, you look right, you look left again, you look right. You don't ever stop looking. The risk doesn't stop. And I think that's kind of what you're getting at, is that maybe there's a desire for people kind of, there's a certain segment of the population realizes that frankly, the nanny state is not fun. It's not fun to be put into a padded uniform.
Yeah, all gray is not a pretty color. Sounds like a great place to raise commodity traders. You got to look
and
be aware of that much.
Look, and I've mentioned this on some of my other podcasts. I was speaking earlier this spring in mainland China, and I have to tell you, sometimes people think that Westerners will say about the Chinese, their religion is money. I can report with firsthand experience, the mainland Chinese tell you that their religion is money. They don't beat around. I mean, they say we are going for it.
Yeah, it's certainly changed. I was first in China in the late 1970s, and everybody that was there wanted me to bring them home to America. And now, when I go to China, I've had 3 or 4 books in Chinese. They want to buy a house for me and have me come live there. I spoke at their Stanford unit, their comparable Stanford lecture there. It's totally changed now that it's opened up, and they really are about making money, which really means they want more freedom, because that's what money buys you ultimately, is freedom, nicer lifestyle, a freedom to live a nicer lifestyle. And they really want that, and they are working so hard for it. Yeah. It's, amazing opportunities there.
I remember walking down the street this spring, and I passed a basketball court, outdoor court, and there was a bunch of young guys, probably 17 to 22, playing hoops. And I mean, these guys were 6'1", 6'4", all wearing sweatpants, running around dunking. And I was thinking to myself, I don't think a lot of Americans realize that they're handing out milk and meat here these days. And I would tell the Chinese, I said, I said, you guys remind me a lot, and some of these speeches, you remind me a lot of Americans, because in America likes everyone to say, hey, we're number one. Well, I'll tell you what, the Chinese view themselves as number one too. And anybody that thinks that it's just an American playing field and it's not global today, I don't know how to convince you.
Well, yeah, that's a great point. It has become more global. And I think in part because America, part of our leadership has backed away from wanting to be number one. We don't want to be number one. We certainly don't have a policy of that anymore. It's, well, we have to be fair to everybody, and we've been colonialists all these years, and we shouldn't be number one. Like, what a stupid attitude. I mean, I don't care if you're Taiwanese or you're a Singaporean or Indian, your country should be number one for you. You have a right to earn that position. And for some reason, so many people here have just backed off from that.
Yeah, it's interesting. It's interesting that we're talking today with some of your political background. I caught some this morning that they were having the great political debates in D.C. about debt ceilings and whatnot. And let me end up with that. Let me let you kind of describe, if you're willing, how do you see? And I think your politics these days is mostly libertarian. Is that correct?
Very correct.
So if you were to give advice to somebody, and because look, I know that if I say the word libertarian, which is where I kind of think of myself, most people will kind of in America give you kind of a slanted eye, like, well, what's that? And still, but why do you consider yourself libertarian, and what are the advantages for you philosophically? How did you get to that point? I know I covered a lot of ground today, Larry. You got a lot of experiences. I'm sorry I'm going everywhere.
No, that's fine. It's made it enjoyable. I got to that point because I was tired of seeing politics of either persuasion having a Band-Aid philosophy. Oh, there's a problem, we'll put this Band-Aid on, which is usually more money. But there was no thinking or theory behind why these things were done. Libertarians, whether you agree with them or not, they are consistent in their approach to government. I've known Ron Paul for 35 years. His views today are the same views he had 35 years ago. He is consistent. And I may or may not agree with him on everything, but I know exactly what I'm getting with him. I don't know exactly what I'm getting with most Republicans and most Democrats, because they're all over the board. It's whatever panders to people that are going to vote for them or give them money. That's the driving force of their political theory. And I really like to see some consistency in government. And we need government. We need it to do certain functions. And it just needs to be done on a consistent basis. So we understand the limitations of government, as we've talked about earlier, and the greatness of government. And I think that's what libertarians offer, is consistency. Might disagree with them, but you know where they're going to stand on the issues.
Yeah, I couldn't agree more. Hey, Larry, where can the audience, and obviously the audience is going to already know where to find you, but where is the best place for them to go connect with you? Your website, your Twitter, Facebook? Where do you want people to best be directed?
Well, at 71 years of age, I don't want any more friends. I'm trying to lose them. Some of the ones I have right now, so I have no Twitter.
You don't hold on. Does that mean you don't want anyone showing up at the Virgin Islands, knocking your door and saying they're going to take you to lunch? You don't want any of that?
We've had that happen. But the best place is our website, ireallytrade.com, because even as an old man, I still really trade. So ireallytrade.com. There's a lot of stuff there, a lot of free stuff. And, we're not much into marketing anymore, but that's the best place to reach me.
Okay. Well, how is the? I've been to St. Thomas, but
I can see across out of my window. I can see St. Thomas.
How's the weather today?
The weather's beautiful. We kind of live in perpetual summer. The tax code here is so great. If you qualify, your state, federal, and local tax is 4%.